Listen, something just happened in the gold market that every retiree holding physical gold needs to understand right now. And I'm not talking about the price going up or down a few dollars. I'm talking about a fundamental shift in how gold is being valued, traded, and most importantly, how it's being used as collateral in the global financial system. And if you're sitting on gold coins, bars, or bullion thinking you're safe, you need to hear what I'm about to tell you. Because here's what nobody's talking about. While you've been watching the spot price tick up and down on your screen, there's been a massive divergence happening between paper gold and physical gold. And that divergence just hit levels we haven't seen since 2008. Let me explain what that means for you. Right now, as I'm recording this, there are roughly 100 ounces of paper gold claims for every single ounce of physical gold sitting in COMEX vaults. Think about that. 100 people holding contracts that say they own gold, but there's only one actual bar to back it up. It's like a game of musical chairs, except when the music stops, 99 people are going to be left standing with nothing but a piece of paper. And the music is getting very, very quiet. Here's what triggered this. 3 weeks ago, the Shanghai Gold Exchange did something unprecedented. They started offering a premium for physical delivery. Not a small premium. We're talking about $70 per ounce over the London spot price. Now, if you understand how gold markets work, that should send chills down your spine. Because the Shanghai price and the London price are supposed to be the same. Gold is gold, right? An ounce in China should cost the same as an ounce in London, minus shipping and insurance. But it doesn't, and that spread is widening. What's happening is simple supply and demand, but on a scale that's breaking the system. Physical gold is being pulled out of Western vaults and shipped east at a rate we've never seen before. In October alone, Switzerland exported 187 tons of gold to Asia. That's not normal. That's panic buying disguised as central bank reserves management, and here's where it gets personal for you. If you're a retiree holding gold, you probably bought it for one reason: safety. You wanted something tangible, something real, something that couldn't be printed into oblivion by central banks. And you were right to do that. But what you might not realize is that the gold you're holding is about to become significantly more valuable than the gold being traded on exchanges. Let me tell you a story. In 1980, there was a man named Nelson Bunker Hunt. He and his brother tried to corner the silver market. They bought physical silver, they bought futures contracts, and they demanded delivery. And you know what happened? The exchanges changed the rules. They implemented position limits, they raised margin requirements, and they basically made it impossible for the Hunt brothers to take delivery of the silver they'd paid for. The price collapsed, and the Hunts lost billions. Now, I'm not saying we're going to see an exact repeat of that, but I am saying that when physical demand overwhelms paper supply, the system has two choices: deliver the metal or change the rules. And history shows us which option they usually pick. Here's what's different this time. In 1980, it was two billionaires trying to manipulate a market. Today, it's entire countries. China isn't speculating. Russia isn't gambling. India isn't playing games. They're systematically converting their dollar reserves into physical gold because they see the same thing you see. The dollar's purchasing power is being destroyed, and gold is the only asset with 5,000 years of monetary history. The numbers are staggering. Since 2022, central banks have purchased over 2,000 tons of gold. That's more than the entire annual mine supply. And they're not buying paper gold. They're not buying ETFs. They're demanding physical bars, and they're taking delivery. The People's Bank of China just reported their 18th consecutive month of gold purchases. 18 months. Every single month they're converting dollars into gold. And here's the kicker. Those are just the official numbers. The actual purchases are likely much higher because China doesn't have to report everything. When they buy gold through Hong Kong, through Switzerland, through private channels, none of that shows up in the official statistics. Some analysts estimate China's actual gold reserves could be 3 times higher than what they're reporting. So what does this mean for you? It means the gold you're holding is about to go through a revaluation. Not because the price is going up in dollar terms, although it is, but because physical gold is separating from paper gold. The premium for holding the actual metal, the real stuff you can touch and store, is going to explode. We're already seeing it in coin premiums. American gold eagles that used to trade at $50 over spot are now $150 over spot. Try to find a 1-ounce Canadian maple leaf for less than $100 over spot. You can't. The physical market is already pricing in scarcity. But here's where most retirees are making a critical mistake. They're holding their gold in the wrong structure. They've got coins in a safe deposit box or bars in a home safe, and they think they're protected. And they are, to a degree. But they're missing the biggest advantage gold offers: tax-advantaged growth. Quick aside here, because this is important. If you're sitting on $100,000 or more in retirement savings, there's a way to hold physical gold inside your IRA without triggering taxes or penalties. I put together a free guide that explains exactly how this works. It's in the description below. It covers the IRS rules, the approved depositories, and how to roll over existing retirement accounts into physical gold. Worth checking out if you want to protect your retirement savings while keeping the tax advantages. All right, back to what's happening in the market right now. Because while retirees are sitting on physical gold, institutions are playing a very different game, and understanding their game is crucial to understanding where gold is headed next. Let me walk you through what's happening behind the scenes. There's a mechanism in the gold market called unallocated gold. Most people have never heard of it, but it's how the majority of gold trading happens. When you buy unallocated gold, you don't own specific bars. You own a claim on a pool of gold. It's like having a share in a gold fund, except there's no regulation requiring the fund to actually hold all the gold they claim to have. The Bank for International Settlements just released data showing that unallocated gold positions have grown to over 9,000 tons. That's more gold than Fort Knox supposedly holds. And here's the problem. Nobody knows how much physical gold actually backs those positions. The banks don't have to disclose it. They just have to maintain enough gold to meet daily redemptions, which, under normal circumstances, is about 2% of total claims. But these aren't normal circumstances. What happens when 3% of people want their gold? Or 5%? Or 10%? The system breaks. And we're starting to see cracks. In September, the London Bullion Market Association had to issue a statement reassuring participants that there was adequate physical gold to meet delivery obligations. When was the last time they had to do that? 2008, right before Lehman Brothers collapsed. Now, I'm not saying we're about to see another 2008, but I am saying the stress in the physical gold market is reaching levels that historically precede major dislocations. And when those dislocations happen, the people holding paper claims get crushed, and the people holding physical metal get rewarded. Let me give you a specific example. In March 2020, during the COVID panic, something extraordinary happened in the gold market. The futures price in New York traded at a $70 discount to the spot price in London. That's backwards. Futures are supposed to trade at a premium because of carrying costs. But there was so much demand for physical delivery that the futures market broke. People were willing to pay more for a contract that delivered gold in 2 months than for gold available today, because they couldn't get physical gold at any price. The premium for physical gold coins went to $200 over spot. Dealers were sold out. Mints couldn't keep up with demand. And if you were holding physical gold during that time, you could have sold it for massive premiums. But if you were holding a gold ETF, you got the spot price. No premium, no scarcity value, just paper. That's the difference between physical and paper. And that difference is about to matter more than ever. Here's why. The Federal Reserve is trapped. They can't raise interest rates high enough to kill inflation without crashing the economy, and they can't lower rates without reigniting inflation. So they're stuck in this middle ground, trying to thread a needle that can't be threaded. And while they're doing this delicate dance, the dollar is losing purchasing power at a rate that's devastating for retirees on fixed incomes. Think about what's happened to your grocery bill in the last 3 years, your electricity bill, your insurance premiums. Everything costs more, but your Social Security check barely budged. That's inflation. That's your purchasing power being stolen. And gold is the only asset that's kept pace. Since 2020, gold is up 80%. The S&P 500 is up about the same, but that's with massive volatility and risk. Gold just quietly climbed, no drama, no crashes, just steady appreciation. And more importantly, gold maintained its purchasing power. An ounce of gold still buys roughly the same amount of goods it did in 2020, while the dollar buys significantly less. But here's what most people miss. Gold isn't going up. The dollar's going down. Gold is just sitting there, being gold, doing what it's done for 5,000 years. It's the measuring stick. It's the constant. And when you measure everything else against gold, instead of against dollars, you see the real picture. The real picture is that we're in the middle of a currency crisis. Not a sudden, dramatic crisis like Zimbabwe or Venezuela. A slow, grinding crisis where your savings lose value every single day, so slowly you barely notice until you look back and realize your retirement nest egg buys half of what it used to. And the people who understand this, the smart money, They're not waiting around to see how this plays out. They're moving into physical gold right now. Not next month, not next year, right now. I was talking to a dealer last week who told me something fascinating. He said the profile of his buyers has completely changed. 5 years ago, it was mostly older guys, preppers, gold bugs who'd been buying for decades. Now, it's 40-year-old tech executives, it's doctors, it's successful business owners who've never owned gold in their lives. They're coming in and buying $100,000, $200,000, sometimes $500,000 worth of physical gold in a single transaction. Why? Because they're looking at their brokerage statements, seeing their net worth in dollars, and realizing that number is meaningless if the dollar is being debased. They want something real, something that can't be hacked, can't be frozen, can't be inflated away. And here's the thing about physical gold that makes it different from every other asset. It has no counterparty risk. When you hold a stock, you're dependent on the company performing. When you hold a bond, you're dependent on the issuer paying you back. When you hold dollars in a bank, you're dependent on the bank staying solvent and the FDIC having enough money to cover deposits. But when you hold physical gold, you're dependent on nothing. It's yours. It's real. It's in your possession. And that independence, that sovereignty, is becoming more valuable every day as the financial system becomes more fragile and more controlled. Look at what's happening with CBDCs, central bank digital currencies. The Federal Reserve is actively developing a digital dollar. And when that launches, they'll have the ability to track every transaction you make, to impose negative interest rates on your savings, to freeze your accounts if they don't like your politics or your purchases. That's not conspiracy theory. That's stated policy. They've published papers on it. But they can't do any of that with gold. Gold is outside the system. It's the ultimate opt-out. And as more people realize that, as more people understand what's coming, the demand for physical gold is going to overwhelm the available supply. We're already seeing the early stages. The U.S. Mint is rationing gold eagles. They can't produce them fast enough. The Royal Canadian Mint is backed up for months. Perth Mint in Australia had to suspend some product lines because they couldn't source enough gold blanks. This is happening right now, while gold is still relatively available. Imagine what happens when the general public catches on, because right now, gold ownership in the United States is around 5% of investment portfolios. That's nothing. In the 1980s, it was over 20%. In the 1930s and 40s, it was even higher. We're at historic lows for gold ownership, which means we're at the very beginning of this trend, not the end. And here's what history tells us about gold bull markets. They don't move in straight lines. They move in waves. We get a surge, then a consolidation, then another surge. And each surge is bigger than the last. From 2001 to 2011, gold went from $250 to $1,900. That's a 660% gain over 10 years. Then it consolidated for a decade, bottoming around $1,050 in 2015. Since then, it's been climbing again, and we just broke through $2,100. But here's the key insight. We're not in a normal bull market. We're in a monetary reset. The Bretton Woods system that established the dollar as the world's reserve currency is breaking down. Countries are trading in their own currencies, bypassing the dollar. The BRICS nations are developing alternative payment systems. Saudi Arabia is accepting yuan for oil. The entire architecture of the post-World War II financial system is being dismantled, piece by piece. And when that system finally breaks, when the dollar loses its reserve currency status, gold is going to be revalued at levels that seem impossible today. Some analysts are talking about $10,000 gold. Some are talking about $20,000. I've even seen credible arguments for $50,000 gold based on the amount of currency in circulation versus the amount of gold available. I don't know what the number will be. Nobody does. But I do know this. The people who own physical gold when that revaluation happens are going to be protected, and the people who don't are going to watch their purchasing power evaporate. So here's what you need to do. First, assess how much of your wealth is in physical gold versus paper assets. If it's less than 10%, you're underweight. If it's less than 5%, you're dangerously exposed. Second, make sure the gold you own is actually physical, not an ETF, not a mining stock, not a certificate. Physical gold that you can hold or that's stored in your name in a segregated vault. Third, consider the tax implications. If you're holding gold outside of a retirement account, you're paying capital gains taxes on any appreciation. But if you structure it correctly inside an IRA, that growth is tax deferred, or even tax-free if you use a Roth structure. That's a massive advantage that most retirees are leaving on the table. And fourth, don't wait. The time to buy gold is when it's boring, when nobody's talking about it, when the premiums are reasonable. Right now, we're in that window. Gold is making new highs, but the mainstream media isn't covering it. Your neighbors aren't talking about it. There's no mania yet, but that's coming. And when it does, premiums are going to explode, availability is going to disappear, and you're going to be paying $200 or $300 over spot just to get your hands on a coin. I've been watching gold markets for over 2 decades, and I've never seen the setup we have right now. The fundamentals are screaming. The technicals are confirming. The sentiment is still skeptical, which is exactly what you want to see at the beginning of a major move. And most importantly, the physical market is showing stress that historically precedes massive price dislocations. This isn't about getting rich quick. This is about preserving what you've spent your entire life building. It's about making sure that when you're 75 or 80 or 85, you can still afford your medications, your groceries, your lifestyle. Because if you're holding dollars, if you're holding bonds, if you're holding anything that's denominated in currency, you're watching your purchasing power decline every single day. Gold doesn't decline. Gold doesn't inflate. Gold just is. And that stability, that permanence, is exactly what retirees need in a world where nothing else is stable or permanent. So take this seriously. Do your research. Talk to a reputable dealer. Understand your options. And most importantly, take action. Because the window for buying physical gold at reasonable premiums is closing. The smart money is already moving. The question is, are you going to move with them, or are you going to wait until everyone else figures it out and it's too late? The choice is yours, but make it soon. Because what's happening in the gold market right now isn't going to wait for you to be ready.